Thank you everyone for joining in today's call on a Saturday. We have been doing weekly fund manager series, particularly on the traditional or more common asset sides, like equity and debt. But this is a unique session where we would talk about alternate asset classes, which people are not usually aware with or not acquainted with. And we have invited Mr. Shaurya Arora, who is the Chief Investment Officer at UTI Alternatives, and he has been with UTI since 2017. Prior to joining UTI, he has worked with Religare Capital Markets, WL Ross, Lehman Brothers, and Merrill Lynch. And he is an MBA from IIM Bangalore. Thank you, Shaurya, for joining in and addressing our clients.
You're welcome, Al. Happy to be here.
We would start with the basic question, and for the better understanding of our audience, what do we mean by alternate investments? What kind of asset classes are included here, which are not easily accessible to a retail investor?
No, you call it a very basic question. I think the question probably is not as basic as one would think. Because it's a question we do get asked frequently because, obviously it's an asset class that is growing very rapidly. It's emerging, but growing very rapidly. And a few years ago, I think nobody had heard of this asset class. And today it is probably the buzz in the market, talk in the town. Every asset manager is coming out and launching alternate investment fund as a product in different segments. So I think it's something, that everybody knows about, but maybe not as basic as you think. But just, fundamentally, as the name suggests, alternate investments is an alternate to something, right? It's obviously an alternate channel of investing. And what it essentially means is that there is a mainstream and there's an alternate. The mainstream for us, as we know, is mutual fund, right? Mutual fund is the mainstream investing avenue available for everybody, right? Of course, but there are many things that mutual funds are unable to do. There are many investment opportunities in the market that are not suitable for investing via the mutual fund, because mutual fund comes with it a certain set of regulations, a certain set of requirements. From an investor perspective, mutual funds usually are open-ended, which means that they need to have the redemption options, which means that mutual funds cannot invest in things that are not investment opportunities that are, for example, not liquid. To give you an example, right?
Absolutely.
Then there are certain requirements by regulations in terms of, having to, for example, in fixed income, or for example, in the nomenclature of the fund, what sort of investment size that you can invest into, what sort of diversification that you can do. Now, but there is a huge universe of investment opportunities available outside of that. That, it does just because mutual funds cannot invest there doesn't mean that they're bad investments, they're not suitable for investors. It's just that it's a market available out there that cannot be tapped through the mutual fund route. And therefore, that's the alternate route available for you, the alternate investment fund, to invest into that market. Now, just like in mutual fund, you have equity and you have debt. Even in the alternate markets, you have equity, you have debt, and then you have other markets, for example, the real estate market, for example, the commodities market. So, so alternate investments is nothing but a different market of investments available for tapping. And AIFs are nothing but a different set of regulations made available by SEBI for pooling money from investors to tap into that market. So I hope, in a nutshell, I've been able to explain the basic concept of alternate. It's an alternate investment avenue available to tap a market that may not be accessed through the traditional route.
Right. And as you rightly said that there has been different set of regulations by SEBI on alternate investment funds. Could you touch upon, there are different kind of alternate investment funds. Could you touch upon what category or what kind of alternate investment funds are out there in the market?
Certainly. So, one of the things, obviously, one cannot pool money from the people or from public or from even privately from a large group of investors without there being any regulations around it. because that's SEBI's mandate to so otherwise there are potentials for frauds and scams, etc., where people can collect money and run away if it's not a regulated product. That's the fundamental reason why regulations exist, right? And especially why mutual fund regulations exist, right? That there need to be norms around what investment managers who are pooling together a pool of capital from investors for a certain purpose, what disclosures are required, what norms are to be followed, what valuations need to be done, what audits need to be done, right? So, of course, mutual fund regulations were designed for an offering which is available to the general public. I think the ticket sizes there are very small. So, obviously, the investors there, a retail interest needs to be protected there, right? An uninformed investor who should also have a degree of level of protection available inbuilt into the regulations, because you can't, if you're putting 10,000 rupees into a mutual fund, you can't read the you're expected to read all the documents, but you can't be expected to be sophisticated enough to understand many of those things, and you're relying on the regulations too. Therefore, the regulations are more restrictive there. They are thicker there. There are more heavily regulated in the mutual fund side. But when we talk about alternate investments, the design of the alternate investments was, and the regulatory thinking there was, that this is a product meant for more sophisticated investors, because not everybody will require to access the alternate market. The traditional market may be good enough for the small ticket investor, because the investment needs of that portfolio are not that diverse, right? But the alternate investments is meant for investors who have more diverse requirements because they have a larger portfolio. And as a larger portfolio, some of these restrictions, for example, liquidity, you may not require for some portion of your portfolio, right? So you could allocate that money to illiquid investments, which come to the alternate route. So therefore, the regulations were designed with protection built in for assuming that the investor into this product is a sophisticated investor. The threshold determined in regulations today is that the minimum required, there are two thresholds, either thresholds. One is that the investor in this product class is going to commit at least 1 crore. So if somebody is putting in 1 crore of rupees into this sort of a fund, then it is assumed that that investor is sophisticated enough to do some extra level of due diligence before investing in terms of what the underlying risk being taken by the fund is. Alternatively, SEBI has come up with the concept of accredited investors, which is agencies have been nominated, which bases your net worth, your investable surplus, and other criteria, certify that you are accredited, which means that you're assumed to be sophisticated because you have a large enough balance sheet or a large enough AUM. So then you don't have to put 1 crore, you can put even smaller amounts, and certain other concessions are available to the investor so that the fund manager can design products that are even more suitable for that investors. So that's on the regulation side, that concept of how the regulations are structured in AIF, and therefore the regulations in AIF are not as prescriptive as they are in mutual fund. Beyond that, regulations, like you pointed out, categorize AIFs into 3 categories, right? And category 1, 2, and 3. If I look at the market size, the bulk of the market, I think the last data released by SEBI was that the commitments are about 8.5 lakh crores in AIFs, out of which almost 7 lakh crores is in the category called category 2. And category 1 has about 50,000 crores and category 3 has about 80,000 crores. So roughly the size of the AIF categorization market. So while SEBI has categorized the market into category 1, 2, and 3, the market has evolved into category 2. Category 1 and category 3 are not that large. And category 2 is rapidly growing. So last 1 year growth in the commitments to category 2 was about 35%. Right? So it's growing at a 30+% CAGR. In fact, there are some forecasts in the market that if it continues to grow at the CAGR power of compounding, in 4 or 5 years, this market might be as big as the mutual fund industry. So it's a rapidly growing market segment. But coming back to what are these categories? While category 2 is the predominant category in the market, we should also know what these categories are. So category 1 was meant. So firstly, what is the differentiation between different categories is that the regulatory norms applicable are different for different categories. So while there's an umbrella alternate investment fund regulations, there are sub norms within the regulations, and certain additional restrictions or concessions are given to various categories to take care of the perceived risks that these categories might have. So category 1 is perceived to be the favorable category in the regulator's mind, the category where the regulations may not be that prescriptive, because that is a category to be encouraged. So social funds, venture funds, infrastructure funds, special situations funds. So funds where regulator wants to, or believes that these can be encouraged because they're doing, things which are favorable to the economy or favorable to the public policy, right, are there. So they are regulated keeping that in mind, right? Category 3 is the category where the riskiest of business can be done. So for example, in category 3, it is permitted to take leverage. In category 3, it is permitted to engage in hedging or F&O, and put call options, etc., can be done. Now, those are instruments that are more complex, which are more perceived to be higher risk, and therefore require higher prescription in the regulations on what can be done. So in terms of, for example, the diversification norms are much heavier for a category 3 than compared to category 1 in the regulations itself. So category 3 in the regulator's mind is where it is perceived to be the highest risk taking has to be done, then you come to category 3. And then category 2 became the catch-all, that if you're not category 1, if you're not doing category 3, you're in category 2. So it is perceived to be the medium segment, where if you're not planning to take leverage, if you're not planning to engage in options, etc., then you can come into category 2. And therefore restrictions are designed, keeping that in mind, that this fund will not be taking leverage. So, you can have some lesser level of regulation because leverage increases risk of a fund, for example, right? So that is the broad categorization that have been done in the regulations. Beyond that, a lot of the regulatory framework has left it to disclosure, that, the fund manager or the fund house or the AMC would just disclose their strategy either in the fund documents or in the presentation or in the product documents. And then within those framework, the basic framework set by regulations, and the regulations don't prescribe that you can only do equity in category 1, 2, or 3, or you can only do debt in category 1 or 3, or you can only do, so those prescriptions are not there, right? It is simply that, beyond the, for example, category 2, you cannot take more than 25% exposure in a single investment, but that's it, right? For example, beyond that, it's up to you to set your norms, communicate your norms to the investor, and then let the investor take an informed call in the segment, because the alternate market is so large, so diverse, you cannot have a one-size-fit-all sort of a prescription, and you can't further, and there's no need to further categorize into multiple smaller categories. Right? So that's where, categories come from. Where the market has also further evolved is, and this is a little bit of the regulation itself, because of taxation. So the taking a cue from the SEBI norms, many other regulators have been giving, concessions or stringent norms for investments in various categories. So for example, IRDA permits insurance companies to invest in category 1 and 2, but not category 3. From a taxation perspective, category 2 funds were given a pass-through status. So category 2 funds pay tax. The investor in the category 2 fund pays tax on the income made by the fund when he receives an income. And the fund only gives a report to the investor that this is your share of the income. Please file it in your tax return and pay tax as per your tax bracket.
Right.
Whereas in the category 3, the distribution is not taxed, but the fund itself pays tax. So which means that in a category 2 fund, for example, if you have some favorable taxation, if you have some tax benefits, some tax losses, you can take advantage of those if you're in category 2, but you can't take advantage of that if you're in a category 3. Conversely, if you're an individual, you may be in a higher tax bracket, whereas the category 3 fund may be an LLP or a company which is paying a lower tax rate compared to you. So those are the things one starts looking at, because the other regulators have decided to make regulations based on categories that are defined by SEBI.
Right. Absolutely. It's a very important point that category 2 has a pass-through structure. I think mutual funds also have a pass-through structure and becomes easy at the hands of investors.
So mutual funds actually are, the unit is taxed. So there's one difference between mutual fund and, AIF, which is something that the industry has been talking about for a long time, but I don't think anything has happened. So in the mutual fund, your unit is taxed. So you hold the unit, and only when you transfer the unit, tax incident comes.
Right.
Whereas in the AIF, the unit is not taxed, your income from the fund is taxed. So, if today the fund has generated an income, that becomes your income. Whereas if the mutual fund has generated an income, until it is paid out to you or distributed or transferred, you don't pay tax. So it's a fun nuance. But I think that the pass-through status in category 2 is an important feature that should be considered by investors, because the book from both sides. If you have some benefits, you can utilize those benefits. If you don't have benefits, you have to factor in that the income that you make or the income returns that category 2 invest funds communicate are on a pre-tax basis. You need to adjust for taxation.
Absolutely. And you operate a real estate focused strategy in category 2. How do you see the real estate market developing in the country? Because it's been an asset class where the ticket size is large, liquidity is low. People don't find it very easy to invest in this asset class. So how do you see the real estate market developing in the country?
So yes, we operate a real estate strategy. It's called Real Estate Opportunities Fund. It's the first of our series right now, but we also, historically, we've been operating credit, not just focused in real estate, but across categories. So real estate for us is a segment of the credit market. So it's real estate credit that we operate in, because broadly real estate, is in two big buckets in the country. Internationally, it has bigger buckets. One is credit and the other is REITs. So it's commercial real estate yielding play. So if you invest into REITs, which is you own buildings, which are rented out to tenants and earn the rental income, that is one real estate investment strategy. And the other is giving loans to builders against their projects. These are the two broad strategies that are there in the market. From our background and where we have more, experience or learnings probably is in the credit side of it, because that's the sort of funds we operate, right? But of course, for us, it is one of the other credit segments. So, from a credit perspective, underwriting is very similar, whether you're talking about real estate or you're talking about real estate. From a market perspective, where do we see real estate, headed? To give you an indication, for a long time, we did not have a real estate fund. And it's only this year that we came out with a real estate fund. So that should give you an indication of where directionally where we think real estate is. Of course, real estate is now on an upswing is our view, which is why we decided to jump into the real estate market, right? I think we have the benefit probably of 2-3 data points. One is the research done by all these IPCs, the international property consultants, who come out with regular research reports. And I'm just going to focus on the residential credit market, because that's probably where our focus is more. So I may be able to contribute more on that side. Now, the data for the last 2 years was showing that the unsold inventory with builders is drastically reducing, which means that number one, new supply in the market is probably lower. And number two, offtake is higher. This was what data was telling us over the last 2.5 years, that over the last 2.5 years, the market is not, 100% accurate data is difficult to come by, but broadly the numbers that were being reported were saying that builders had between 50 to 60 months of inventory. If I look into 2019, 2020 timeframe, which has come down to between 20 to 24 months today. Which means if you look at the unsold inventory lying with builders as a whole today, and you look at the last quarter sales, and you divide the two, at the same sales velocity, what the builder would sell in 5 years, he's got only 2 years worth of inventory left over, which obviously indicates that it is not just a function of, that inventory has disappeared from the market. Inventory can't evaporate, it has to be sold. So homes have to be sold, plots have to be sold, units have to be sold for the unsold inventory to come down, which means sales have picked up, right? And maybe addition of new inventory has reduced. So many builders, and we've seen this, a lot of builders have gone into insolvency, etc., and are not coming out with new products or new projects. So over the last 2.5 years, data was telling us, that sales have picked up in the real estate market. I think a year or a year and a half ago, that would be more data. Few people who are actively involved in the real estate market would be telling the same thing. But as a general market, that would not be the market view, maybe a year or 2 years ago, a year and a half ago, that the market is on an upswing. But I think subsequently, this thing has become now something that everybody seems to agree with. and it is not a agreement that is not backed up by actual experience in the market, or when you look at projects. Because then when we look at projects, we were seeing sales MIS from potential portfolio companies, where we were seeing the same thing that we could see across the board. Sales have increased over the last year or two compared to what they were before that. So I think this increase in velocity of end buying, because eventually in any market, when the customer comes into the market is in a bull phase, right? So customers have come back, sales are happening, and now we are in fact seeing price rise also happening. Earlier it was just about clearing inventory. Now it is about increasing the price of the underlying inventory, because now pricing power seems to be coming back to the builders. So I think from a real estate perspective, we are seeing a positive trend on the customer market. We are still seeing a constraint in the finance market. So builders are still constrained for finance, probably because of the NBFC crisis that we had in the country. NBFC as a source of finance for many of the builders is still not there, or has not come back. In fact, NBFC's commercial real estate exposure has dramatically crashed since ILFS happened. So from a real estate, so therefore customers are supporting the builders. The financiers are coming back into the market, but not with the same bullishness or with the same gust as which, and when I say financiers, I mean the traditional sources. I'm saying bank and NBFCs. Banks and NBFCs remain, regulated in that segment very heavily by RBI in terms of what they can do for lending to the real estate sector. So that constraint was always there. It exists because real estate lending is perceived to be higher risk and therefore more highly regulated and higher risk exposures, etc. But I think the market dynamics for real estate are shifting for the positive. That seems to be, at least in our experience, being shown by the data that we are seeing, that the real estate market is on an upswing.
Absolutely. And for an individual, when assessing a real estate project or doing the due diligence of a builder, it becomes very difficult for an individual to do it. How do you assess as a professional fund manager and with a professional fund management team? How do you assess any real estate project or do due diligence for a builder?
So, what I'm going to tell you is going to be true whether I'm looking at real estate or not real estate. Credit due diligence is not in that sense reinventing the wheel, right? Credit has been around for ages, and the question only is how do you execute the due diligence, right? How much detail do you get into the steps? We all know, right? We have to look at each project, and there are 4 or 5 risks that you break it down into, right? The first risk is the approval risk. In a real estate project, what approvals are available today vis-a-vis what are required tomorrow, and what is the certainty that those approvals will come. Because real estate in India is a state subject. Different states have different regulations requiring, different levels of approval at different stages. So for example, in certain stages, some approvals come at the ground level. Then you have to go back after reaching a certain level, you have to take certain approvals. And, you can start work. In certain places, 100% of the approvals are required upfront before you can even take. Environment, for example, is a different, sort of constraint that you have to, work with. So number one risk you have to evaluate is approvals, right? Number 2 risk you have to evaluate is execution. So you may have all the approvals, but do you have the ability, capacity, and the track record of actually completing that project? Because a project takes 3 years, 4 years. In our country, 3 years is what people generally talk about, but we've seen projects get 30 years and not get completed. So just because you have all the approvals in place, there's no guarantee that the project will still be delivered. You have to make sure that there is financial closure, for example. Builders might run out of money. Over a 3, 4, 5 year period, there may be a price risk because the price of the inputs might increase, steel prices might increase, cement prices might increase, and your project cost overruns might be there. So the second risk you have to look at is execution risk. Third risk you have to look at is sales risk, right? Because there is no guarantee that customers will come. You might have got the location wrong. You might have got the the configuration wrong. You might be selling 4 BHKs in a market that is a 2 BHK market, or vice versa. So the sales risk is the third risk one needs to evaluate. And the fourth risk you want to evaluate is risk of misrepresentation and frauds, because eventually you are relying. There is no title guarantee, for example, in our country. Nobody is 100% assure you that this piece of land is owned by this particular party. There can always be disputes. You go back 10, 15 years ago, there might have been a transfer of title through, questionable means or through disputed means, or there might have been wills that are under dispute. So, you have to also make sure that you have factored in that there could be misrepresentation here. There could have been some element of, either fraud being played upon you or being played upon your counterparty in the past that might come and, create problems for you today. So these are the four main risks we've identified that you have to look at in a real estate project, and not necessarily in a real estate project, but any other credit underwriting that you also do, right? Now, for us, how we evaluate risk, and different people might have different ways, of course, is we do a combination of in-house and outsourced. So we engage specialist vendors. So for example, on the approval side, on the execution side, right, we engage specialist real estate focused firms who will analyze the project for us, and then we review it. We also do in-house work. So we go do our own site visit. We go do our own broker checks in that market. What is the sale rate here? What do you think about this project as a broker? Will it sell? So we do a combination of those. And of course, from for the misrepresentation part, we do two things. One is we engage lawyers, and we engage the tier 1, tier 2 lawyers to go through all the papers, go through whatever, can be identified through whatever sources, get done. And we also get a background forensic check done through one of the big 4 agencies to make sure that if there's any, hidden skeletons in the closet, those come out to us. And so a combination of external vendors along with internal reviews and in-house due diligence and in-house reference checks is what culminates into a due diligence process that we follow in order to manage and assess a project for the risks that are there. Because project assessment is nothing but risk assessment, because once you've agreed on, especially in a credit, once you've agreed on the rate of interest, then you have to make sure that whatever is the, things that can go wrong, that what they are, and you have provided for them. So I think that's a very institutionalized process one follows. I agree with you. I don't think even if individuals know how to do it, they have the capacity to do it. This can only come when you're talking of, you can afford to spend that sort of a budget, which can only happen if you can afford to give the builder a large amount of corpus in one shot. So, like any other alternate investments, that's the whole point of having a pooling vehicle or a fund manager, that you outsource risk assessment or to a fund manager. So you're effectively engaging a fund manager, you're hiring a fund manager to assess risk for you, because you, of course, don't have the, the bandwidth or even the capacity to do it on your own.
Absolutely. And you, apart from the real estate strategy, you also run a private credit strategy. And predominantly, we have been seeing that private credit is being dominated by the banking system in India. So what are the challenges and opportunities you see in this particular space, in the private credit market?
Yes. So we've been doing private credit since 2017. So we were one of the first, one of the first asset managers to get onto this market of segment of private credit, right? And we've been focused on the mid market. So what I'm telling you is coming from an experience of being in the mid market, largely the MSME segment, or MSME plus, a little bit higher than what the government's formal definition of MSME is, right? That's where we operate in. But let me also just give you then a little perspective of what private credit is, or at least what private credit means to us, right? Because there's again no formal definition of private credit, I think, in the market. So, private credit is generally understood as something. For us, private credit is nothing but the alternate to the corporate bond market. Because today, the corporate bond market in India, there are several efforts by SEBI and RBI to deepen the corporate bond market in our country, but those efforts may not have been very successful, because today our corporate bond market is limited to either the sovereign, so government securities, semi-sovereign, which is the PSUs, the BFSI, the banks, essentially, and some of the AAA large corporates, right? The big large caps of the country are the only ones who are able to tap this market of, bonds, either by issuance to the public or to institutional investors like treasuries and mutual funds, etc. The main constraint is because of liquidity, right? Any other bond below these bonds is illiquid, and therefore, not many takers for that paper. But the requirement of the corporate bond market exists below, in the lower end of the chain also. So just because you are a 1,000 crore company or a 2,000 crore company and not a 10,000 crore company, doesn't mean that you don't need credit. from alternate sources from time to time. Why do these, large cap issuers come to the corporate bond market? Because they have some requirement of loans that banks are not able to give them or not able to give them efficiently for various constraints. For example, regulations, right? Banks are not allowed to lend for certain purposes. Now, when banks are not allowed to lend for a certain purposes and you still want to borrow for that purpose, you have to look at NBFCs and you have to look at the corporate bond market. Similarly, if you're a 1,000 crore company or a 2,000 crore company, if you need money for that purpose, you look at an NBFC, but there was nothing else available beyond that, which is why the corporate bond market is required in every country, not just us, right? It's a much deeper market in the world economy. It's less liquid, less deep in our country. So therefore, in India, we think of private credit as the market makers in that segment, because if you have to participate in that segment, you have to go in with the view that this is illiquid paper, that you have to hold to maturity. So you have to walk in as if you are a bank and you are coming and giving a loan, even though you're holding debentures, because you may not find a buyer for those debentures. So this is a loan that you're holding to maturity, right? But the reward in that segment is huge. You can make a 500, 600, even 700 basis point spread over the bank lending rate for the same risk, right? Because of the lack of participants in the market. So that's what private credit is for us, right? That there is a market segment out there where a deep market should exist, but an illiquid, shallow market exists. And if you participate in that, you are taking a different sort of risk, but the reward for that is much more attractive and therefore worth taking that risk. And the risks are twofold. One is credit risk and the other is liquidity risk, right? And those are simply the same risks. So credit risk is the same risk you take anywhere, right? You take that risk even in the AAAs of the world. You take that risk even with the sovereign government's default. So it's a matter of pricing the risk properly. It's a matter of identifying that if credit risk was to play out, come true, what is it that you can do to, minimize your losses? And, liquidity is something that, anyway, AIFs are meant to be illiquid. Category 2 AIFs are meant to be illiquid. So that's easily taken care of because investors come into the fund knowing that they're coming into an illiquid fund.
Right. And I personally believe that our equity markets have become very mature, but debt market, bond markets, we are still a long way to go. And therein the opportunity lies.
Therein where you find arbitrages. So we find that there's a credit arbitrage in the private credit market and the mid market. Right. So it's a classic definition of arbitrage, right? That because of illiquid, less evolved markets, that's where you find something that should be priced at 2 percentage point higher, you can price it 6 percentage point higher. So 4 percentage points is the arbitrage return you make in, and in fixed income credit 4 percentage points. 4% is a huge delta, right?
Right, absolutely. One question that we have on YouTube is there have been a lot of small ticket size P2P loans or private bonds that are coming by some of the digital players. And people actually don't understand the risk. When it comes to mutual funds, they know that it's a market-linked product and there is a market risk associated with it. But in such products like P2P loans, where there's a high interest rate offered to clients, they don't usually understand the risk, and they don't have any professional fund manager managing those assets. So what kind of risk that are associated with a high interest rate bond or a high interest rate credit? If you can just light upon that.
Certainly. So you take risk every day, right? Nothing comes without risk. I mean, even if you were to take your money and put it under your mattress, right? You run the risk of theft, you run the risk of, decay, you run the risk of, termites, right? So nothing comes without risk, right? And that's where you earn your income from. Risk reward goes hand in hand. So certainly you may hear the term mutual funds are subject to market risk. Alternate investment funds are also exposed to market risk. It's just a question of what is that market that we're talking of, right? When we talk of equity mutual funds, we're talking about the equity market. When we talk of fixed income mutual funds, we're talking about the credit market. Similarly, in AIFs, the underlying market that we invest in, we are exposed to that risk. And therefore, investors are exposed to that risk. So when we talk about credit funds, right, private credit funds in the AIF space, certainly you are exposed to a risk. And since if you're investing in a fund that is participating in the mid-market credit, you are exposed to mid-market credit risk by definition, right? Now, risk is a fun, so risk can be managed by 2-3 things. One is by appropriately pricing the risk, right? So if in a portfolio level approach, if you have appropriately priced the risk that, I have 50 investments, if 2 go bad, the balance 48 go good, what is the return on the balance 48 that gets delivered? And overall in my portfolio, what is the return I made? If it is good enough, then I can afford certain sort of, NPAs. So that's one perspective with which you can approach risk. The other perspective you can approach risk is by saying that, look, I don't think anything should go bad. So let me take the minimal risk instruments at, whatever pricing is available, and then build in some more safety nets. So for example, then you can say, I will only do secured exposures, right? So I will not participate in bonds where the underlying does not have security of a certain magnitude. Or you can do a combination of two, right? You can say that I will invest in a large enough portfolio, which is reasonably priced so that I can afford credit risk events. And secondly, I will make sure that, I have safety nets. If tomorrow something was to go wrong, I have something available so that, my losses are minimized. So, the main risk being taken is credit risk in a credit risk fund, for example. Of course, in an equity risk fund, the risks are different, but I'm just talking about credit risk because that's where I have more experience. And so as a private credit AIF investor, you have to know that the main risk you're taking is credit risk. There are other risks, like I mentioned, there are liquidity risks, right, available. There will be taxation risks available because, you're a pass-through. So tax is at your hand. So you have to understand your own taxation. So there are, everything has risk, but the main risk you take is a credit risk. And therefore, the fund manager's job is to identify, mitigate, and manage the credit risk predominantly, right, in a credit risk. So that's what our job becomes, to make sure that we are evaluating credit risk properly. And we have backup plans available because, you cannot know what can go wrong, but you have backup plans available on events that you can forecast. So therefore, that's the main market risk that we take, and why a fund manager, what role the fund manager plays, because our full-time job is to monitor, manage, isolate, identify, and handle the risks in the portfolio.
Right. And that's where the skill set of a professional fund manager lies, to identify those risks and help investors invest in these alternate opportunities. Now we'll invite questions on the chat box. People can write in their questions on the chat box or on YouTube page. So one question that we have is about the time horizon. So when we talk about equity markets, and as a professional fund manager, we usually recommend to go long-term, beyond 3 years, 5 years. In an alternate investment class, what is the time horizon that people should be actually looking at to get the returns and then to get the proper liquidity in their investments?
So I think, in the mutual fund, typically you invest in open-ended funds. So time horizon becomes a choice with you as an investor.
Right.
In an AIF, and category 2 AIF I'm talking of, because that's the bulk of the market, and the funds need to be close-ended. So the time horizon is built into the fund. So that's an evaluation you will do before investing, whether it's the opposite evaluation, whether the time horizon of the strategy chosen by the fund manager, if it's an equity fund and the fund has a 7-year horizon or an 8-year horizon, is it adequate? If it's a credit fund, if it has a 3-year horizon, 4-year horizon, 5-year horizon, is that adequate? So it is at the beginning that you will choose whether this fund has chosen the right time horizon for the sort of strategy they're doing, for the sort of returns I'm getting. Typically, in our experience, in the credit category, investors are in it for 3 to 5 years. Both investors as well as the underlying, because in a credit, it is, credit risk is very different from equity risk, right? In equity risk, you're looking for giving that long time tenor to make the multiple on your investment because of the compounding, and also because, you know, equity takes time. Equity takes a little bit time to play out, right? Whereas credit is a running, you know, distribution sort of an investment play, right? Because you've invested into a debenture, you've invested into a loan. That loan, the faster it pays you back, the happier you are. Of course, you run then the risk that where do you earn the return again from, because the money coming back to you, you have to reinvest somewhere else. But the perspectives are very different. So at least, but from a timing perspective, right? Because you're investing in closed-ended funds, I mean, the evaluation is the opposite. You have a time is chosen for you, and you have to decide whether this is the right tenor of the fund or the wrong tenor of the fund before making the investment, as opposed to an open-ended fund where you get to choose when to enter and when to exit.
Right, absolutely. And the next question itself is on the reinvestment risk. How do you see the interest rate market coming up? What's your view on the interest rate market and the inflation numbers that we are seeing in the market?
You know, it's a question more appropriately asked to you know, our colleagues in the mutual fund. From an AIF perspective, we are investing in hold to maturity. So really, there is no, whatever investments we do, we are, you know, number one, not largely they are in debentures that have a fixed rate, very little, you know, market linkage. There are some market link products that we also invest into, but largely they're fixed rate so far that we've done. And secondly, they're hold to maturity. So, you know, from a hold to maturity perspective, market interest rate movements don't really bother me, right? So, you know, it's a question better asked and a view better taken from our mutual fund counterparts. From our perspective, because we are hold to maturity, you know, market interest rate views is something I wouldn't like to comment on.
Surely. I think we have answered all the questions. Thank you so much, Shaurya, for such an interesting session. All the great insights about the private credit, real estate markets, alternate investments. And it's been lovely hosting you. We look forward to do such sessions with you and your team in future. Thank you everyone for joining in on Saturday for this session.
Thanks so much, my pleasure.